Hello everyone, welcome to Financial Management course. I am Dr. Kurniawan Yusup, Sarjana Ekonomi Magister Management, and I will be your lecturer for Financial Management course. Before we begin, let me ask you a simple question. If you have limited money, would you spend it, save it, invest it, or use it for starting a business? Financial management will help us understand how to make these decisions logically and responsibly. So today, I will briefly explain to you the course description, learning outcomes, learning system, course modules, and also course roadmaps, learning methods, assessment system, and a short teaching demonstration. Financial management is 3 credit course delivered over 16 weeks. This course will cover both corporate finance and also personal finance. Corporate finance will focus on how companies manage money and make investment decisions, while personal finance will focus on how individuals make decisions about saving, borrowing, and also investing. The main references include recent financial management textbook by Brigham and Houston, Singh and Carr, and also Ross, Westerfield, and also Jordan, all published in 2024. The course learning outcome for this subject is students are able to analyze problems in the field of corporate and also personal finance and accurately find solutions in accordance with fundamental principles in finance. By the end of this course, you will be able to create financial plan for your business project based on all the materials that you have learned over 16 weeks. Now let's talk about our learning system. The main learning approach is project-based learning. So you will not only listen to lectures, but you will also work with the real financial data, solve business case, analyze the company, evaluate investment, and also create financial plan. The mode of our class will be offline and hybrid. And also, we will integrate some technologies in our course. We will use Microsoft Excel for calculation and financial modeling, Canva for visual presentation, and also AI as the supporting tools. This is the course roadmap of this subject. The course consists of 4 modules. The first module is financial statement analysis. The module will be delivered from week 1 to week 4. In this module, students will study financial management fundamentals, financial statement, free cash flow, financial ratios, and company performance analysis. In the end of module 1, there will be AFL1 in which you need to compare 2 companies and evaluate their financial ratio. The second module will be time value of money. The module will be delivered from week 5 to week 8. You will learn present value, future value, compound interest, annuity, and also discounted cash flow. In the end of this module, you will have AFL2, which is individual quiz. The third module is corporate and also personal finance. This module will be delivered from week 9 to week 14. The topics include cost of capital, capital budgeting, capital structure, dividend policy, working capital management, and of course, basic stock analysis. In the end of this module, there will be 2 assessments. The first assessment is individual quiz regarding corporate finance, and the second one will be individual stock analysis report. The last module, which is module 4, will be delivered in week 15 and also 16. So the students will combine all the knowledge from the previous modules to create financial plan for business project. How is the learning method of this course? So this course will use short lectures, case discussion, individual exercise, group assessment, Excel-based analysis, quiz, presentation, and also question and answer session. Now let's go to the assessment system. The assessment system consists of 4 main components depending on the module. AFL1 is the assessment of Module 1, which is financial statement analysis, and it will wait for 20%. It will be group assignment with peer assessment. AFL2 will be individual quiz as the assessment of Module 2. It will also wait for 20%. Now AFL3. AFL3 will wait for 40% and all will be individual. It will be divided into two components. The first one is corporate finance quiz, which is individual, and also stock analysis report, which is also individual. And the last one is ALP. In the ALP, you need to create financial planning report for your business project. It will wait for 20%. It will be group assignment and there will be question and answer in week 16 to evaluate your understanding. For all these assessment, the assessment rubrics will be explained more thoroughly before each assignment so that students can clearly understand the expected standard. In this course, of course, there will be class rules, and these are our general classroom rules. For students who are late in submitting the assignments, students will get score reduction or assignment rejection. Shall any plagiarism found in the assignment or exam, the students will get 0 for that assignment. Regarding the attendance, the student's attendance will open only for 15 minutes. Meaning, if you are late more than 15 minutes, you are not allowed to get your attendance. And if you are absent more than 3 times or 25%, you are not allowed to join final exam or ALP. And the last one, don't forget that students must also be active in the class interaction. So, have you been ready for financial management course? Now, let's take a look on the example of our classroom.
Okay, good morning, everyone. So today we will continue our class about financial management. So today we will cover capital budgeting material. As last week we already learned about cost of capital. This is the continuous part of cost of capital. We will learn about capital budgeting. What capital budgeting is, we will learn deeper through today's materials. So here are the outline of our agenda. So the first one, we will learn about what is capital budgeting, and it will be continued with the capital budgeting calculation. We have several calculation, NPV, payback, discounted payback, IRR, and MIRR. After that, we will have exercises together. Okay, before we start, I have a question for you. So, there is Fresh Cup Cafe. Fresh Cup Cafe currently is considering buying a new automated coffee machine. And the machine costs 100 million rupiah today. Okay, now please try to expect that it generate additional cash inflow for 4 years. My question is that, would you buy the machine? Anyone?
I think I will find like some additional factors to uh support my analysis because the information is still lacking here. I cannot really consider to buy or no.
Okay. What additional information that you need?
Probably about uh the specific amount of money that may be produced. Is it exceeding from the cost today or no?
Okay, specific amount that can be produced through this machine exceeds the cost to produce or not. Okay, Joa?
Yeah, I think it's too expensive, mister, because to get back the money we spent for that machine, we have to do our business for 4 years. I think it's too expensive.
So your decision is no.
Yeah, I would buy their machine that is cheaper.
Okay, as long as the machine costs lower, you will purchase. But in 100 million, you will not purchase. That's correct? Okay. So when you decide something, it is correct that you need more information. Okay, not only this information. Okay, so you need a lot of factors like the cash flow, the income, and also the expenses. Okay, and also in the beginning, in the first module, you already learned as well about time value of money. You have to understand that money, the value of the money right now is different with the value of the money in the past and the value of the money in the future. Therefore, we need to consider it as well. For example, in your business, in year one, you get 100 million. In year two, you get 100 million. The value of the money will be different, okay? Because of the concept of time value of money. Now, to decide whether you need to purchase or not the machine, there is concept we call as capital budgeting. Okay, capital budgeting. So basically, capital budgeting is the process of evaluating and selecting long-term investment project. Okay, for example, you want to buy equipment like previously I analyzed. Okay, like previously I mentioned. For example, as well, you want to open a new branch, you want to launch a new product, you want to build a new factory. Okay, this is long-term investment project. Okay, how to evaluate, how to select it? Of course, you need capital budgeting. Okay, according to you, why capital budgeting is important?
So you can decide the right decision.
Because it is important to decide the correct decision, the right decision. Why should we decide correctly? Because it requires, for example, large initial investment. Okay, like previously 100 million. Okay, or perhaps if you purchase machine, meaning like you have to use it for several years. It will affect the company for several years, and it will be difficult or expensive to reverse. For example, okay, I don't like the machine, and then like, okay, I will sell it again. It will be difficult for that. Okay, and of course, it will influence the company future value. Okay, therefore, when you try to decide to purchase or not, you need to answer this basic decision question: will this project create value for the company or not? Basically, the principle is very, very simple. Just accept the project when the value of its expected benefit is greater than its cost. So if benefit is higher than the cost, so you have to accept. If the cost is higher than the benefit, you should not accept. Now, this one are the steps to capital budgeting. Okay, the first one is that you have to be able to estimate the cash flow, the outflow, and also inflow. Okay, the inflow, for example, the revenue. Okay, the outflow, can you give the example of the cash outflow?
Salary, probably.
Salary, very good. And then operating costs, right? It is the example of cash flow. And you have to be able to estimate it annually. So from year one, what is the cash inflow? What are the cash outflow? Year two as well, year three as well, and so on. Okay. After that, you need to determine appropriate cost of capital. Okay. So basically, the cost of capital here to estimate the minimum required return that reflects the project risk. Still remember last week we learned about the cost of capital. The term we call it as WACC, weighted average cost of capital. Okay, you can get the capital from several sources. It can be through the debt, it can be from preferred stock, and also from common stock or equity. Okay, so after you calculate WACC, okay, it will be used later for the capital budgeting calculation. Okay, so basically the WACC, it is the discount rate used to evaluate the project. Okay, now how to evaluate the project? There are several indicators here. The first one is NPV, net present value. The second one is payback period. The third one is discounted payback period. The fourth one, IRR. And the fifth one is modified internal rate of return or MIRR. Okay, so it will be better for you to calculate all these calculations to determine whether you should accept or reject the project. Okay? Now, to explain each of them, I will directly explain through the example directly. So we will have exercise. Okay, we will have exercise. When we do the exercise, I will explain it one by one. For example, there is a project, I need initial capital. Okay, since it is initial capital, so it will be the cash outflow. I have to spend money in year 0. For example, it is minus 100. Okay, I use small number to make you easier to understand the concept. Okay, in year 1, after we calculate the inflow, turns out like the cash flow will be 10. Year 2, 60. Year 3, 80. Okay. There is additional information here. Required rate of return. Usually it comes from the WACC. It is 10%. And then maximum acceptable payback period is 3 years. And then reinvestment rate for MIRR 10%. So we will calculate NPV, payback, discounted, IRR, and MIRR. After that, we will decide whether we should accept or reject the project. Okay, before that, this is the knowledge for you about each of indicator. So guys, basically for NPV, it is the present value of expected cash inflow minus the present value of cash outflow. This is the formula of NPV. Okay, so I believe like you already familiar with this formula when we learn about time value of money. Okay, so later I will try to simulate how it works. Okay, you accept if NPV is higher than 0, meaning the present value of inflow, okay, is positive. Okay, net present value of the inflow and also outflow is positive. So it creates value, so you should accept the project. Okay, payback period and discounted payback period, actually the concept is the same. The time required to recover the initial investment from cumulative cash inflow. Okay. However, the difference is in discounted payback period, it pay attention on discounted cash inflow. Okay. It pay attention on the time value of money. Logically, you should accept the project if the payback period is higher or lower than acceptable payback period. Any idea, Aldo? Logically, you should accept the project if the payback period is higher than acceptable payback period or lower.
I guess it's supposed to be lower, so the payback must finish before the expected, so we can earn the profit, right?
Okay, lower or shorter, yeah. If the payback 2 years and then the acceptable 3 years, so you should accept. If not, then just recheck it. Okay. The fourth and fifth one, it is almost the same as well. It is internal rate of return and modified internal rate of return. In internal rate of return, so basically we try to calculate the discount rate that makes the NPV equal to 0. Okay, if the IRR is higher than the R or cost of capital or required return, we can accept. Okay, so does MIRR. If MIRR is higher than cost of capital, we should accept it. Okay, in MIRR, the difference is that we consider the reinvestment rate for positive cash flow. Okay, now we will go to Excel directly. Okay, now you can see here, there are year and also cash flow. This is the questions that you already get before. Okay, the first indicator is that NPV. Okay, net present value. Simply, basically, to understand net present value is that we find the present value for each year. Okay, how is the way? Simply, cash flow divided by 1 plus R to the power of year, like this. Okay, but we have to input the R first. What is the R, the required return? Previously, it is known it will be 10%. Okay, so the present value, it will be minus 100 divided by 1 plus 10%. Okay, we make it absolute to the power of 0. because it is in year 0. Okay, and then we drag it down. Okay, we can find the present value for each year. Okay, the total here we call it as NPV or net present value. Just sum it all. Okay, so sorry, this is not percentage. Okay, we sum it all. These are the number. The NPV is 18.78287. Okay, it is in the form of currency. Okay, if it is rupiah then rupiah, if it is dollar then dollar. Okay, so based on the result of NPV, the NPV is 18.78287. Should we accept the project or not based on the NPV?
Yes, Mr. We should accept it
Why?
because the NPV result is more than 0, which means it's a positive.
Okay, because the
The
NPV
fit.
is higher than 0. Okay,
Yes.
it is positive, so we should accept the project. Very good. Okay, the next one is payback period. Okay, I will copy here, payback period. Okay, I will copy first. Okay, so guys, payback period is that the time for you to return the initial capital. Okay, the initial capital, it is 100, right? Because in year 0, you spend 100. Okay, in which year exactly your initial capital is returned? Okay, so simply you can find accumulated cash flow. Okay, how to find the accumulated cash flow? So in year 0, since you spent 100, so your accumulated cash flow will be minus 100. Okay, in year 1, you get 10. So the minus 100 plus 10, the accumulated cash flow is minus 90. And so on in year 2 as well. Okay, in year 3 as well. Okay, your initial capital is back to you when the accumulated cash flow is positive, right? You can see here in year 2, it is still minus 30, meaning your money has not been back yet. Okay, in year 3, already positive, meaning your money has been back. Okay, so the payback period, okay, it is around 2 years, right? 2 years something, because in 2 years it's already been back. In 2 years haven't, meaning I can assume that it is 2 years something. So the payback period is 2 years plus in year 2 you need 30 more to make your money back. Okay, in year 3 your cash flow is 80. Okay, you need 30 and turns out in year 3 you get 80. So the payback period will be 2.375 years. Okay, and then in the questions, acceptable payback period is 3 years, right? In the questions. So should you accept the project or not based on the payback period? Joa?
You should, Mr., because it's still under the acceptable payback period.
Very good. So you should accept. Yeah, because the PP is lower than acceptable PP. Okay, the same concept, it is for discounted payback period. Okay, so I will go here, discounted payback period. Okay, so I use the PV. Okay, for discounted payback period, you use the PV and then find the accumulated PV. Okay, the same concept for accumulated PV, it is minus 100, then minus 100 plus 9 something, and then minus 90 something, plus 49 something, and so on. Okay, so the discounted payback period, same between 2 and 3. Okay, so 2 plus this one, in year 2, you need 41 something more, right? 41.32231.405 divided by, in year 3, you get 60 something. So divided by 60.1051841. Okay, so the Discounted payback period is 2.6875 years. Since the DPP is less than the acceptable payback, which is 3 years, so you also need to accept the project. Up to this point, clear ya? Okay, if it is clear, I will go to directly to IRR and MIRR. Okay, for IRR and MIRR, simply we just use the formula. Okay, it is IRR, open bracket, the values, so this one, the cash flow, just block it. Okay, and then just guess. Guess it is not mandatory for you to input. Yeah, just usually I add the required return, 10%. Okay, and then you will find it is 18.13%. Okay, which one is higher, the IRR or required return?
IRR.
IRR. So if IRR is higher than required return, we should accept the project. Okay, same with MIRR ya. So use MIRR, the values block 8, finance rate just put 10%, the investment rate same in the question, it is also 10%. Yeah, enter. This one is 16.496%. Same, MIRR is higher than required return, so we should accept the project. Okay, clear enough? Any question? No questions? Okay, now I will go back to the PowerPoint. Okay guys, so this is the summary basically of our calculation. I have summarized it. Okay, so you can see here NPV is higher than 0, payback period is less than 3 years, discounted also, IRR higher than 10%, MIRR is higher than 10%. So based on the analysis, we should accept the project. Okay, for next week, I have assignment for you guys. So regarding the capital budgeting as well. So this is EcoBox packaging machine. So EcoBox itself is considering buying a new environmentally friendly packaging machine. Okay, here are the cash flow and also with additional information. So you have to calculate and estimate the NPV, payback, discounted payback, IRR, MIRR, and also final investment decision. You can use financial calculator or also spreadsheet. Okay, you have to submit your answer before next meeting in eLearn. And next week, we will continue our discussion. Okay, so we will discuss your result and continue to the next materials about working capital management. Okay, before we end the session, I would like to ask you about the summary that you learned from today's material. So perhaps like we start from Vanessa. What things that you learned from today's material?
From today's material, I learned about the capital budgeting. That is a tool for us to evaluate and to make the right decision, what project to invest on.
Okay, very good. Yeah. So you want to evaluate the project, in which project that we should invest and not invest. Okay. Richaldo, perhaps?
From today's lessons, I learned that capital budgeting is one of the tools that we can use to make us keep objective and not be biased by a project. So we have various indicators to support whether we should accept or reject the project objectively.
Okay. Okay, thank you, Richaldo. All right. So I think that's all our materials today. Before I end the session, any question? Okay, if there is no questions, thank you so much, guys, and don't forget to do your assignments and see you next week.
This concludes my explanation of financial management that I teach in International Business Management Universitas Ciputra, Surabaya. Thank you for your attention. Hopefully, this introduction can be useful and beneficial. See you in class.